Are you on the verge of retirement? Do you expect to inherit a portion of your parents' hard-earned savings stashed away in their IRAs? It's an exciting prospect, but before you start making grand plans for that windfall, there is something crucial you need to consider, and that's taxes. Recent changes in the law, along with IRS interpretations, could significantly impact your inheritance. In case we haven't met yet, I'm Dr. Javon Jackson, your favorite fiduciary financial advisor, and welcome to another installment of Money Motives, good news from the world of finances in 8 minutes or less, where once per week we bring updates, uplifting developments, and encouraging trends for your financial future. Last week's episode was on nervously nearing retirement, the 4 do's, 4 don'ts, and 1 never to-do list. So go back and check it out if you missed it. So let's dive in to today's topic. As of the first quarter of 2023, Americans collectively held over $12 trillion in IRA funds. And if your parents have diligently saved throughout their lives, you might be in line to inherit a portion of that wealth. But hold on a moment. Before you start daydreaming about early retirement or luxury cars, you must understand the potential tax implications, because inheritances from traditional IRAs have always come with tax obligations, but the rules have evolved even further. So, in the past, if you inherited an IRA before 2020, you could take advantage of a strategy to extend withdrawals and taxes over your life expectancy. And it was a tax-saving method that actually worked well for many people. But enter the Secure Act of 2019, which ushered in significant changes. And for most non-spouse heirs who inherit in traditional IRAs on or after January the 1st of 2020, that tax-saving strategy is no longer an option. Today, non-spouse heirs essentially have 2 choices. They can take a lump sum and pay taxes up front, or transfer the funds to an inherited IRA and deplete it within 10 years. And the 10-year rule also applies to inherited Roth IRAs, but with a significant perk. You won't be required to pay taxes on withdrawals, and there are no required minimum distributions, also known as RMDs. And this offers flexibility and potentially over a decade of tax-free growth. However, there's a twist. Recent IRS guidelines clarify that if the original IRA owner begin taking RMDs, heirs must continue that trend, calculating RMDs based on their life expectancy in years 1 through 9 and emptying the account by year 10. And let me tell you, missing an RMD can lead to a hefty 25% penalty. The IRS has provided some relief for 2021, 2022, and extended it to 2023. But planning ahead is critical. The penalty can drop to 10% if you make up the missed RMDs within 2 years. And to calculate your RMDs, you use the IRS single life expectancy table, considering your age and the previous year's IRA balance. And while taking the minimum is an option, withdrawing more might be tax savvy, considering how it can affect your future tax brackets. So be mindful if you're a non-spouse beneficiary, especially those of you in higher income years. Consider strategically spreading withdrawals to avoid unexpected jumping into a higher tax bracket. And when managing an inherited IRA, transferring the funds is essential to prevent a hefty tax bill. You can't leave the money in the original owner's account or roll it into your IRA. Opening an inherited IRA ensures you have control over investments with taxes deferred until you start taking distributions. But be prepared for paperwork, including a death certificate and beneficiary verification. And if the original owner passed away before taking an RMD, you must withdraw the year of death RMD by December 31st of that year. And the distribution is based on the IRS Uniform Lifetime Table. Now, spouses have more flexibility. They can treat the IRA as their own. They can roll it into their IRA or transfer it into an inherited IRA. So consider converting some traditional funds, IRA funds, to a Roth IRA if you want to leave your heirs a tax-friendly legacy. Non-spouse heirs can still stretch Roth IRAs tax-free. I know that was a mouthful, and honestly, the best advice I can give you, if you inherit or anticipate inheriting an IRA from a non-spouse or your parents or anybody you're not married to, is to seek assistance from a fiduciary financial advisor, because this is something that you can't afford to mess up because it will literally cost you. And so as you approach retirement and you anticipate inheriting a parent's IRA, remember that taxes can significantly impact your inheritance. Understanding the rules and planning strategically can help you maximize what you receive while minimizing unnecessary tax burdens. Don't let unexpected tax bills derail your financial future. Plan wisely and secure your legacy. If you found this video helpful, please like it, share it, and of course, subscribe. And if you're curious about taxes in general and retirement, download my free taxes and retirement planning guide. So all you got to do is click the link below in my description and you can have access to it. So thank you guys for joining for another installment of Good News, Money Motives. Good news from the world of finances. I'll see you all next week for another installment. Take care, and I'll see you guys next week.